Hey everyone, welcome back to the Weekend Charts, where I run through the most important charts and themes in markets and investing. Huge show for you today, a lot of topics to discuss. Today's show is brought to you by my friends at Y Charts. Y Charts is an awesome data analytics and charting platform, and they're offering viewers today a free trial to their Y Charts Professional Edition until December 16th. So, great offer there. Take a look at the link in the show notes. Check out the platform. You can do a lot of interesting research and charting and analysis on this platform. So until December 16th, first 100 subscribers get a free trial to Y Charts Professional, no credit card required. I want to start out today by talking about the housing recession. And so there's a lot of debate still going on about the overall U.S. economy. Are we in a recession? Are we not in a recession? We've covered this many times in the past few months. But as it pertains to the housing market, there's really shouldn't be a debate anymore because the evidence is pretty clear. The housing market is in a recession. So, number of ways you could look at that. Let's first take a look at the NAHB Housing Market Index. And this is a survey every month of home builders measuring their confidence. And when the number is below 50, builders are viewing conditions as poor, more of them as poor relative than good. And when they're above 50, the opposite. So as you can see, we swung here from extreme optimism in terms of home builders to kind of a very negative pessimism. We haven't seen this level of pessimism since April 2020. So during the initial stages of the COVID crash, and then of course it came right back. But here it's kind of a long trend going on now, 11 consecutive months of declines in this index. And if you read the responses to this survey, what you find is month after month, more and more of these home builders saying that they're cutting prices to incentivize demand. So last month it was 37% of builders saying they're cutting prices. Yet the average price cut was around 6%. And so why are they doing that? Well, they're doing that, as we've talked about, because affordability has just collapsed. And so in order to incentivize buyers to come in order to have enough buyers to come in to afford those prices, they have to cut the prices to meet that demand. So this is a trend that's expected to continue throughout the winter. We're now approaching the slower season for home sales and home demand. And so we'll watch this indicator closely to see if it continues lower or it shows a sign of reversing. So it's not just home builder confidence. What that has translated into is lower housing starts, lower building permits. So as you can see here, building permits entered the year at the cycle peak and now have declined to a 26-month low, down 10% year over year. If we look back historically, the shaded gray areas here are recessions. What you tend to see is building permits turned down in advance of the start of recessions in the past. It's actually a important leading indicator for the U.S. economy. And so this type of decline for this long, you don't tend to see without overall economic weakness. So another just sign that housing market definitely in recession, and perhaps this is pointing to broader economic weakness to come as well. And then we have the actual sales. So home builders are less confident. They're building less new homes. And the existing homes that are out there are selling at the slowest pace we've seen since May 2020. And if we look at a year over year rate of change of existing home sales, we see a 28% decline. We haven't seen that type of decline since February 2008. And what was going on in February 2008, the US economy was just entering recession. And so it started in actually January 2008. So big decline in home sales. And as we talked about, you have kind of a various stages of the housing market in terms of how these things translate into price decline. So initially, what you see is affordability collapse. And we've seen that all of last year. And then it just got worse this year with mortgage rates going up and up and up. And when affordability collapses, eventually that translates into lower demand. And lower demand means fewer transactions. So if prices stay the same, you're going to have less buyers coming in. There's going to be less buyers and sellers meeting at a certain price. So you see these actual sales numbers go down. And then over time, what you tend to see is sales are so low, inventories start to build up in terms of the housing market, and we're seeing that definitely in new home sales, and existing home sales starting to creep up as well. And then you see prices come down, and so we're just as we talked about, just a few months into that stage of prices coming down to meet the new reality. So if we look at the median sales price of an existing home in the U.S., it's down now about 8% from its peak in June. And if we look back to the last housing bubble, which is really the only thing comparable to what we saw in terms of the huge advances over the last few years, was that last housing bubble that peaked, at least for median sales price, peaked in July 2006. What we saw following that was a 33% decline nationally in this median sales price of an existing home. So I just did the math very quickly, said if we saw a 33% decline this time around from this peak in June of this year, where would that bring home prices? And interestingly, it really only brings you back to early 2020 levels. So that's how much prices have advanced over the last 2 years, that even a 33% decline is only bringing you back to early 2020 levels. So as we talked about, there's a few ways to make houses more affordable. Number one, of course, is mortgage rates come back down, which would help obviously a lot of people in terms of that monthly mortgage payment. But barring that coming down significantly, what we're going to see is prices, I think, continue to come lower until the affordability equation kind of shifts. So we seem to be a ways away from that if we're looking at the data. And again, we're entering that seasonal peak, seasonal weakness that we have. We tend to see fewer home sales, lower prices in the winter until you get to the spring and summer of next year. So by all accounts, it seems like we're going to see continued weakness in the housing market over the next few months. So, housing recession, the data seems to be clear on that. But the housing recession isn't the only recession that we're seeing. We're also seeing a corporate earnings recession. If we're looking at S&P 500 earnings, this is now the second quarter in a row of earnings coming down on a year-over-year basis. So we have almost all of the companies reported now third quarter earnings. We're down 10% year over year. That would be the second quarter in a row. And interestingly, if you're looking at the guidance and estimates from these companies, are they expecting a rebound in Q4? No, not so much. They're expecting another quarter of negative year-over-year growth in that fourth quarter. So if that's indeed the case, that seems to be priced in by the markets. But what's not priced in by the markets is continued earnings weakness next year. So if you look at analyst estimates looking out to the end of 2023, what they're actually predicting today is an over 10% increase in earnings next year in 2023. So they're predicting a rebound, pretty quick rebound. And what could make that expectation wrong? Well, as you might guess, it would be the economy showing more weakness than it showed this year. So it would be an acknowledgement that, okay, we are definitely in a real recession, and that tends to push earnings down more than we've seen so far. So 10, 15% earnings decline so far is nothing compared to what we typically see during a recession. So if we see that economic weakness, we could see those expectations change. And so in terms of leading indicators of that weakness, we talked about some of the housing data tends to be an important leading indicator, but the yield curve is by far the one I think pointing to just really a red flag here for the broader economy. And it seems like every few weeks I talk about a different inversion in that yield curve. And so we started out with the 10-year and 2-year. That was all the way back in April. And then last month, we talked about the 10-year and the 3-month inverting. And now we have the entire yield curve finally inverting for the first time, with the 1-month Treasury yield moving above that 30-year long duration Treasury bond for the first time that we've seen since 2019. So this is a chart just simply showing you that 30-year yield minus the 1-month yield. And as you can see, we started way up here entering the year. And with all of the rate hikes, the Fed is directly controlling that 1-month short-term Treasury bill rate, which is very quickly approaching 4%. and now that 30-year is actually starting to move lower. So we have that combination leading to this relatively unusual inversion of that 30-year and 1 month. So what were the last two times that we saw the yield curve invert? The full yield curve invert. We have uh, August and September 2019. As you know, there was a recession that started in March 2020. And when I tweet this out, the immediate response is always, well, how did the yield curve know that there was going to be a pandemic? Of course, the yield curve didn't know that, but it was sensing economic weakness. So maybe probably the recession wouldn't have started that month absent the pandemic, but it was sensing a recession to come at some point in the future. It just happened to come earlier that time around. And so we have August 2006, August 2007 before that. And what the market was saying back then, economic weakness, the recession didn't start until January 2008. So we've talked about the yield curve. There tends to be a lag between inversion and the start of recession. It's not there's nothing precise about it. We've looked at averages and they're all over the place. There's some recessions that happen relatively quickly following inversion, but oftentimes it takes some time. And every single recession is different. And I think this time around it will be as well. So again, that 10 and 2 years inverted back in April. And now we're seeing just that full yield curve inverted. And why is it happening? Well, you got two factors. One, you have that Fed pushing up short-term interest rates, and the expectation for the market is that the Fed at some point early next year is going to stop, and then the Fed is going to start cutting rates late next year. And because of that expectation, that long end is coming down because investors are buying long-term treasuries on the anticipation that inflation is going to come down, long-term growth rates are going to come down, and so they're getting a bid for those long duration treasuries and driving those yields lower. So that's the signaling power of the yield curve, and we'll see how that plays out. But yield curve is just one leading indicator. The conference board puts together a whole bunch of leading economic indicators, and they have this index that they look at, combining all these, and they have a growth rate, and that's what you're seeing in this chart here. And going back to around 2000, whenever we've seen this compilation of indicators, the growth rate in these indicators at these negative levels that we're seeing today, tends to be a leading indicator of a recession coming relatively soon. So we saw that back in 2000, preceding the 2001 recession. We saw that back in 2007, preceding the 2008 2009 recession. And we saw that obviously in 2020 very quickly moving down with pandemic recession. So here we are currently. This is a composite of a bunch of leading indicators, and many of them are moving in the direction that tends to precede broader economic weakness. And I think if you ask people today, and I just did another poll on it, are we in a recession? Are we going into a recession within, let's say, the next 6 months? Most people are thinking that we're either in one today or going to be in one relatively soon. So you could say that the expectations are already, this is one of the most telegraphed, let's say, recessions because of all of the data that we've had in terms of the yield curve, in terms of the housing market. There's just earnings. There's just any number of indicators that we have that, at least according to this poll and a couple of the polls I put out in the previous few months, it wouldn't be a surprise if the NBER came out any day and said the U.S. economy is in a recession. And so just looking at this poll, around 49% said we're already in a recession, 40% heading into a recession, and just a little over 11% saying no recession today, and we're not going to be in one for the next 6 months. So we'll check back, in every month or so to see if this kind of expectation changes. But at least for now, I don't think it would be shock to anyone to see a recession in 2023, at least an announcement. And when that exact start date will be, of course, remains to be seen because it's a subjective decision by that NBER. And so why are people continue to be nervous about the recession? And typically when you have a recession, when you have a bear market, we've talked about this, what is the Fed doing? well, they're already starting to cut interest rates. And as we've talked about, the Fed is still hitting the brakes, and they're likely to do so for at least the December meeting based on the market's expectations. So currently, market pricing in another 50 basis points. But this is a real different picture than we've seen in recent bear markets, where the Fed response was always cut rates, expand the balance sheet. And this is something we haven't seen in terms of the Fed hiking rates this year from 0 to 3.75% already, with another 50 basis points likely coming in December. And then people are expecting, if we look at market expectations, rate hikes to go around 5% by early next year. So the same time they're doing that, they're reducing the balance sheet. And so we haven't seen this combination of Fed tightening policy in a bear market, in a potential recession since the early 1980s that we talked about. And that's really the most similar comp that we have, because back in the early 1980s, what was the big problem? Of course, it was inflation. And so the Fed back then, just like they're doing today, is viewing getting inflation under control as the bigger priority, and risking the economy going into a recession, which every single day seems to be a higher likelihood that it will. So if we look at that Fed balance sheet, this is a chart looking back over the last year, and what we're seeing today is that the balance sheet's at a 52-week low. We haven't seen the balance sheet at a 52-week low since December 2019. So starting to accelerate here. I think it's a little over 130 billion in the last 5 weeks. We haven't seen that much of a contraction since mid 2020, which was very brief, and then the Fed started buying assets again. But we have 340 billion so far from the peak. And again, this is expected to continue. Around 95 billion a month is expected by the markets. And in terms of the drawdown, it's pretty small so far. So off of its high, it's only around 3.8% off of the high from April that the balance sheet hit. And we, if we look at the past two big drawdowns in the balance sheet, they've been, of course, much more significant than this. So the one that bottomed in August 2019, almost 17% decline in the balance sheet, and then in February 2009, you had almost 18% decline. But something very interesting, if you notice, about both of those declines is once you hit a low there, very quickly the Fed starts moving in the opposite direction. So in 2009, by early 2010, the Fed was ramping up QE again, and assets hit a new high there. And as you know, in 2019, Fed starts buying bonds again, ahead of the pandemic. And then when the pandemic hits, they buy more bonds on a dollar basis than they've ever bought in history. So will the same thing be true this time around? It's anyone's guess, but when you get to the point where the Fed feels like its work is done and perhaps it needs to move in the opposite direction, the historical precedent is that the Fed seems to do so very quickly. So hopefully it won't be at a point where we're facing something similar to these two examples, where you have a financial crisis or a deep short-term recession like that pandemic caused. But the Fed has a history of reversing course very quickly, and I think their bias, if they still have one, and I think they do, their bias is to be easing. So we'll talk a little bit about the signs of the inflation rate coming down. And I think, as the data continues to come out like that, you're going to hear more chatter from the Fed about slowing down, about potentially pausing. And then if the recessionary data comes through as expected next year, perhaps moving in the opposite direction. So let's talk about Disney. Interesting chart here. Of course, Disney's one of the biggest U.S. companies in the Dow. The drawdown for Disney, the recent drawdown, 57% from its peak in March 2021. Pretty significant drawdown for Disney historically. It's actually even bigger than the drawdown Disney had during the financial crisis and bear market. It was down 56% back then. So pretty significant. And if you ask, like, how did we get here? What was the issue? Why is it down so much? If you ask people, they'll say many different reasons. But to me, it's just a mean reversion of expectations. So Disney was very much caught up in the overall mania that we saw in 2020 and 2021, and in particular, the digital component, the Disney Plus component. Investors were just wildly optimistic in terms of their expectations for growth, and in terms of how that would translate into future profits for Disney. And I think now you're seeing just a reversion to the mean in terms of that, some of those expectations, because growth, of course, now is slowing down for Disney Plus and those digital areas. So if we look at this chart here, I think it tells the story. Disney's not unique, but it's somewhat unique in that it's not in that firmly entrenched in that technology space, but it was still caught up in this mania because of that digital component. So this is a price to sales ratio for Disney going back in time. As you can see, after pandemic hit, Disney became one of these stocks that was said to will benefit, even though it had huge theme park revenue and business that just collapsed, and even though their earnings collapsed during that period of time, investors were so euphoric about the prospects for Disney Plus, which was growing significantly, just like we saw with Netflix and some of these other Amazon Prime, that they bid up Disney's price to sales ratio to 6 times sales in March 2021. As you can see, uh, nothing even close to it in Disney's history. And since then, as we talked about, growth has slowed, expectations have come down. And now you have a price to sales ratio for Disney that's actually below its long term average of 2x sales. So, big mean reversion in a short period of time. And if you're asking, can that ratio go lower? Of course. If we've seen it before, it can happen again. Back in the lows in 2009, Disney traded at a price to sales ratio of less than 1 time sales. And so anything is possible. Disney could get cut in half again and still have a valuation that's higher than back then. So, better point for investors, obviously, than in March 2021 in terms of valuation, in terms of buying at a discount. But don't assume that just because valuation has come down doesn't mean it can't continue to go lower. So be very careful in the future. If you have a position in something, or you're thinking about taking a position in something that has a chart like this, where investor expectations are just so extremely high and running wild, and the herd behavior is really present with everyone jumping into that, you have to really question, is that optimism sustainable? Because there's a very different, disparate outcomes in terms of what the company's going to do and what the stock's going to do based on those expectations. And when the expectations are extremely high, it just makes it so much harder for you as an investor to benefit from that, even if the stock does well. So just looking at the Dow this year, Disney, second worst performer in the Dow this year, trailing only Salesforce, which we had talked about last week, was added in 2020. They took out ExxonMobil, wanted another technology company, didn't want energy, right? And that ended up being kind of the turning point for the energy sector. And interestingly, the number one stock in the Dow this year is the only energy company left, which is Chevron, up over 61% year to date. So you're seeing across the board here kind of a shift in terms of performance, where you have more defensive sectors leading the Dow: healthcare, consumer defensive, so Coke and Walmart, and energy, of course, benefiting from higher prices of crude oil. And then on the other side, you have technology, communication services, and consumer cyclicals really turning down. So definitely a year where defensive stocks outperforming by a wide margin. Then you have that mean reversion in terms of sector performance, with energy being lifted up and technology obviously coming way down, being the biggest factor. And so with all of the bad news in the about the economy, about earnings, about inflation, the Fed tightening policy, it probably wouldn't surprise you to learn that if you look at some sentiment polls, they're pretty negative. And two examples of that, one would be this AAII sentiment poll. So it's a poll of individual investors. And every week they ask these investors what they think. Are they bullish, neutral, or bearish about the future for stocks over the next 6 months? And what's something interesting that we see here recently, this year is 34 consecutive weeks now where the bears in this poll have outnumbered the bulls. So you have a negative spread if you take the bulls and subtract the bears, because the bears are higher for 34 consecutive weeks. This poll goes back to 1987, and the only other time we've seen uh, sentiment be this bearish, this negative for this long was actually during 2020, which was 34 weeks as well. So we're tied with the most persistent negative sentiment that we've seen. And I think this has been a factor actually holding up the stock market and leading to a number of the bounces that we've seen this year. Is just people are getting positioned so much on one side where you're seeing sentiment is so extremely negative, and then you see these relief rallies where either people are short or they have bought puts, and they're unwinding those positions, and we're seeing these snapback rallies. But very interesting to see more persistent negative sentiment today than any other period other than 2020, and actually more persistent than what we saw in 2008 during the financial crisis, where you had negative sentiment, but you had these bounces above zero, and that would come back down. So this is an indicator, not an short-term indicator for the market, of course, but we showed in the past that when this thing gets very extreme down to these levels, you tend to see better returns looking out 1 year. So all else equal, you'd much rather see negative sentiment if you're an investor rather than positive sentiment. And the same is true for this other poll, which is looking at consumers and asking them what they think in terms of are things good or bad. And if you look at consumer sentiment today, it hit a few months ago. It hit the lowest levels on record, and this poll goes back to the 1950s to 1952. And just the persistent negativity that we've seen this year is something that we haven't seen ever before. So we have a record 7 straight months in this consumer sentiment index below 60. And before this year, the record for a number of months below 60 was 4 straight months back in 1980. And again, 1980 similar to today, inflation, the big concern, and we're seeing that, of course, today. So what's fascinating about this is sentiment is so low today without unemployment rate really moving meaningfully up yet. So you have to wonder, how is it going to look if we start to see the job losses that we're seeing in tech kind of broaden out, and we see that unemployment rate rise, and we see the recession really kind of deepen in terms of people recognizing it and believing that we're in one. How is consumer sentiment going to look in 2023? But given that it's already been this depressed for this long, and I think the big factor, if you read the comments from this index every month, it kind of remains the same. The big factor is just inflation outpacing wages, which is something that we continue to talk about. It's gone on for over a year and a half, where you have inflation outpacing wages, was pretty long time, and that's enough really for consumers to be pretty negative. But two interesting sentiment polls, persistent negativity like we really haven't seen many times in the past. So if we're talking about that U.S. consumer, they seem to be pretty negative, but in terms of what they're saying in these polls. But if we actually look at their behavior, they're not acting on that really just yet. In terms of, if we look at retail sales, it hit another new high on a nominal basis last month, up 7.5% year over year. And in any other environment, let's say in the last 20 years, 7.5% would be a great number, extremely strong growth. But as you know, you can't view today's environment the same as any other period, because we have that high inflation rate. So if you incorporate that and you look at retail sales adjusted for inflation, we're actually seeing a decline of negative 0.3% year over year. So you have to adjust everything for inflation today to get a true picture of the economy and the health of the consumer. But still, it's pretty impressive that even on a nominal basis, that retail sales are up 7.5% because wages are not going up. Wages are up only around 5% in the last year. So how have consumers been able to fill that gap, so to speak? How have they been able to spend more than their wage increases? Well, there's been really two factors driving that, and this has been trending this way for months now, but it really just continues. One, they're borrowing more. If we look at credit card balances, up 15% year over year. That's the highest rate of increase since the 2001 recession. So you got to go back a long time to see credit card balances going up as much as they are. And number two, they're simply saving less money out of their paycheck. So if they saved 5% a few months ago, now they're only saving 3%, which is the lowest since the 2008 recession. So those two factors both combined. As we talked about, when the economy is going to feel the big hit is when these two factors kind of stop, when either people stop taking on new credit or they can't take on new credit. We talked about last week how credit card interest rates were hitting the highest levels we've seen in 20 plus years. So that's going to be a factor, of course, if that continues. And then there's only so much consumers still have in terms of lowering their savings rate. And so at a certain point, they're going to cut that discretionary spending, and these charts will start to reverse in the opposite direction. And I think that's when you have the debate over whether the U.S. economy is in a recession. I think that's how it's settled. And so will that come before we see the unemployment rate rise? Probably not. I think that's going to have to be the factor. You're going to have to see more job losses, and that's going to put fear into people, obviously. And the first thing you're going to do if you lose your job is, of course, cut discretionary spending. And so those two factors are going to be something we watch very closely as a leading indicator for the economy. So if we look at asset class returns this year, it's really been mostly a sea of red. There's been two exceptions of that to that rule, and that's been commodities and cash. So here are the year-to-date returns, various asset classes. You can see everything else in the red. Bitcoin lowest return, but you got U.S. stocks, international stocks, bonds, tips, everything else in the red except for commodities and cash. I just put the T-bill, very short-term Treasury bill ETF, as kind of a cash placeholder. Everything else in the red. So been the toughest year that we've seen for asset allocation. You got to go back to really 2008. Like 2018 had many categories in the red, with the exception of that cash category, had even more than this year because commodities were down too. But the numbers weren't down nearly as much as we've seen this year. So for a broad 60-40, as we've talked about, this is going to be, it's on pace to be the worst year since 2008. But what's going on this year is not what's happened in the past decade or more. As you can see, commodities are leading this year, had a very strong year last year as well. That's been a reversion to the mean from a decade of poor performance before that. So if we're looking at returns since 2011, you have commodities still down, this commodities ETF from where it started 2011. And as you can see, U.S. large caps in the equity space, and if we look at tech stocks, NASDAQ 100, still annualizing at 16% since 2011. So that should give you an idea. Entering the year, this was over 20% of how strong of a run tech stocks and U.S. large caps have had, that even with declines this year, they're still showing over double-digit returns since 2011. And of course, the big mean reversion this year has been in the technology space, as we talked about, and in things like crypto. So Bitcoin had been the best performing asset class 2019, 2020, 2021, and now you're seeing the opposite, worst performing asset class. This isn't anything new for Bitcoin. It was also the best performing asset class in 2015, 2016, 2017. Then it was the worst in 2018. Also best performing asset class 2011, 12, 13, worst performer in 2014. So you have, you could see crypto, very emotional asset class. Bitcoin has these periods of euphoria, mania, and then you have the opposite where the crowd is rushing out, and of course we're in the midst of that opposite scenario today. So how does the decline in Bitcoin compare to previous declines? We're seeing 77% peak to trough now from the peak was only a year ago. And if we look on a duration standpoint, 364 days, this is now the second longest correction ever for Bitcoin. The longest was 2013 to 2015, where it actually declined 85%, but it's now longer than that 2017 2018 pullback that was 84%. So nothing new for Bitcoin. And so this shouldn't be unexpected for investors. You don't have the tremendous gains in an asset class without extremely high risk and extremely high drawdowns. And so I put a poll out to investors seeing where sentiment is today in terms of when will Bitcoin hit a new all-time high again, just for fun, see what the sentiment is. And as always with Bitcoin, you have disparate opinions. You have people that think the worst, and you have people that think the best. So the worst people are saying 33%, essentially saying a third of the people that is never going to hit a new all-time high again. And then you have the remainder saying very few next year, and then the most saying 2025 or later. So people saying it's going to take some time to recover, perhaps a few years, but it will get there. But there's still a big percentage of people saying that essentially crypto is done. And I did a similar poll back in 2017, asking this question with pretty much after that mania broke in 2018, and pretty much similar results where you had a very high percentage of people saying that Bitcoin would never come back. So we'll see what happens. There's certainly the debate's going to continue, and you have, like equities, sentiment gets worse when the asset class is down. Sentiment gets better when the asset class is up. So nothing different in that respect with regards to Bitcoin. So what happened? This is something very bizarre that Sam Bankman-Fried tweeted out in a series of tweets. He started with the word "what" and then spelled out "happened," and then he proceeded to go on to say a bunch of things, none of which actually addressed what actually happened, which was, of course, criminal activity of the likes that we haven't seen at this scale only a few times in history. So, in one of the tweets, he's talking about how assets looked as of a few weeks ago in terms of liabilities and assets, and he's saying that they have more than $1 billion more assets than liabilities, and then a month ago that they had 10 billion more. And so he writes in here lots of caveats, and that's probably the understatement of the century. He also writes maybe that 9 billion illiquid mark to market isn't worth 9 billion, and not maybe, definitely not. And so what actually happened here, we're just starting to uncover in terms of the scale of it. Every single day there's new information, but the new CEO that was put into place to kind of oversee the bankruptcy, John Ray, had a few interesting words to say in his latest filing. He called what happened a complete failure of corporate controls and complete absence of trustworthy financial information, the likes of which he had never seen in his 40 years of legal and restructuring experience. So he's also saying here a substantial portion of the assets held with FTX may be missing or stolen. So we don't have the exact numbers or anything close to it. But to me, everything is pointing to criminal activity here, and one of the biggest frauds that we've ever seen. So a few weeks ago, they leaked this balance sheet that supposedly Sam Bankman-Fried put together when he was scrambling to try to get investors to come in and save FTX from kind of a certain demise. And as you might imagine, after he showed this balance sheet to potential investors, no one decided to invest. And why is that? Well, he alluded to it in to his tweet, and but he said he used words like may not be worth this much, and he was showing that there was still positive equity if you did an assets minus liabilities calculation. But if you dig just a cursory level into the balance sheet, you immediately find huge red flags and things that don't make sense or add up. And I'll just give you two examples of this. Number one, they have this asset in the less liquid category called Serum, SRM as the ticker, and it's this cryptocurrency that FTX itself created, and I won't go through the history of it or anything else because it's kind of it doesn't really matter for this situation. But they're valuing it at over 2.1 billion as of a few weeks ago, and uh, you might ask, well, how did they come up with that number? Is that anywhere near accurate? Could they go out and sell it? Well, if you looked at the actual market cap of this serum, you can find it on Coin Market Cap or a number of other websites. The outstanding market cap, like so, if you take the all of the coins that have been issued to date, multiply it by the price of serum, what you would have got, and on the date this balance sheet was created, was about 100 million in total value. So the question remains, of course, that how did you get to that 2.1 billion valuation? How did you get anywhere close to that, unless you were just kind of making up numbers? The other crazy thing that really jumps out is there's a side note. It's almost an afterthought for some reason, and the wording here is hidden poorly internally labeled fiat account, and they have negative 8 billion of that, which presumably that's some type of liability for negative 8 billion. They don't even have it in the liability section, and he's not including that in his calculation of equity value over here, and he's not including that in his tweet as well. So what is that? And how does he not know what it is at that point in time? Uh, I still don't think that's been uncovered, what that actually is. So you have many other things as well, obviously, with the illiquid values of these securities, probably nowhere near the value, and many of these other less liquid values, if they had to go out and sell it, they're not going to get the price that's listed there. But just a million red flags in this balance sheet, and I guess the big question is why many of these investors in these prior rounds. So in January of this year, FTX was able to raise money at a 32 billion valuation. And why didn't any of those investors request any type of financial accounting? Maybe they did, and maybe they were sent something different. So that's possible as well. But if they were sent anything like this, why didn't that create red flags, or perhaps they didn't request it at all, and it was just herd behavior and trust that they were doing the right thing, and I guess in the future, that's this none of that trust is going to be there. It's going to be a more verify and not trust attitude, I think, when it comes to these things. So none of this happens in a vacuum, of course. It can only occur with the mania that we saw in 2020 and 2021, where people are less skeptical, they're more trusting, and they think they're only thinking in terms of upside, and they're not thinking in terms of risk. So I'm hoping that this will, when they're able to find out where these assets are and value them, I'm hoping the damage to investors and U.S. investors is as small as possible. We don't have really any real data on that. Hopefully, there are assets here to cover some of the deposits, but I think it's pretty clear that criminal activity was here, and it's just a question of how many people within FTX knew what was going on and were complicit and trying to hide these facts from coming out, and how long did they know it? And so the story just gets wilder and wilder, and I think we'll know a lot more probably in a week, and certainly in a month, than we know today. And so one more thing I want to end with, and we usually try to end with positive news. And this is, to me, positive news. Don't usually call bubble bursting positive news, but I think looking at the used car bubble and looking at consumers who've been waiting to buy a car probably in the last year, the used car bubble bursting for those people is certainly a very good thing. So we're just in the early stages of this, so keep that in perspective. It's not a huge decline, but as you can see here, this is a chart of the Guru's used car index, and the declines over the last 2 months really accelerating to the downside. So pretty much every day, if you look at this index, it's been lower over the past 2 months on a consistent basis. And I think what we're seeing there is good old fashioned demand destruction, as the Fed has talked about. So those rising interest rates are having an effect. If you look at the data, over 40% of people who buy used cars finance those cars. New cars, it's even higher. It's over 80%. And so with interest rates going up, it's harder for people to get the loan. It's harder for people to afford that car based on that payment, similar to the housing market. And so you have lower demand, and you have finally have transactions start to come down, and then prices come down. And now we're in that phase similar to the housing market where prices are starting to come down. So how much lower they're going to go, I don't know, but I suspect that we're going to see, at least over the next few months, much lower prices. And if there is a recession where unemployment rises significantly, that's going to hit this thing, I think, much harder, obviously, because the first thing people pull back on during recessions are big ticket items. And after housing, uh, autos are the second largest, usually big ticket items that people spend money on. So a good sign if you're looking to buy a car, you're probably going to get a cheaper price even in the next few months, but just as a good start. And if we look at the Manheim used car index, we just got data for November, mid-November. The year-over-year rate of change there now down over 13%. That's the largest year-over-year decline we've seen on record. Why is this important for broader inflation measures? Well, it was a leading indicator in 2020 on the way up in terms of inflation. And now it's been, as we've talked about, a leading indicator on the way down, where CPI is finally starting to come down. This was anticipating that. And I suspect when we get that November CPI report, you're going to see that used car component down year over year. That's going to be the first time we see a major component in CPI go down on a year over year basis in over a year. So we're getting there slowly but surely. Things are coming back to reality. Even better news than the used car bubble bursting is the fact that fertilizer prices are not only moving lower, but moving lower at a significant pace. So down now 39% from their peak in March to today, and they're at their lowest level since September 2021. So you can remember when the war first started in Ukraine, uh, there was a lot of fears and a lot of rational fears that this was going to cause big problems because Russia's biggest exporter of fertilizer in the world. You have Ukraine, obviously big exporter of wheat. And so all of these factors driving food prices higher. And a number of positive things have developed since then. And we're seeing prices start to move in the other direction. And this is very important for food prices because there's such a high correlation between fertilizer prices and food prices. Or one big input cost for food prices is that fertilizer price. So great news to see it going lower. I hope it continues to go lower. But at the very least, it will take it going lower 39% to date from its peak. That's pretty good, and hopefully that'll continue. So last thing, this is something we've talked about. The global container freight rate index continues to move lower, 23%, 23-month low now, down 73% from its peak. So we're getting there in terms of the supply chain issues like that. Of course, demand's big factor here. Of course, demand destruction is, and anyone who said that rising interest rates wouldn't help with inflation, you're being proven wrong every single day with all of these factors. It's definitely curtailed demand. You're seeing it everywhere you look, and we're seeing it here with this freight rates index as global demand goes down. you're seeing with that supply chain issues are easing, and we're seeing prices come down for these freight rates. So this will take time for this to filter into products, but it's going to mean a lower year-over-year rate of change, and then hopefully some stability in terms of prices going forward. So we'll end with that. Very positive news on the inflation front, and hopefully that continues. Have a great week, everyone. Thanks for joining me. Have a happy Thanksgiving, and we'll see you next week. Thank you.